I lost $11 billion in market value in 4 hours last Tuesday, and I couldn't stop laughing. My team thought I'd finally cracked. The board members were looking at each other with that expression, the one, like maybe it's time to activate the succession plan. But here's what they didn't understand. While they were panicking about the stock price, I was watching something else entirely. Something that's going to reshape wealth distribution in America over the next 18 months. And if you're not paying attention to this, you're going to miss the single biggest wealth transfer opportunity since I started selling books out of my garage in 1994. You want to know what I was watching? Silver. Not Amazon stock, not AWS revenue, not even our upcoming space launches. Silver. That gray metal that your grandmother kept in her dining room cabinet. And before you click away thinking Bezos has lost his mind, let me tell you why the smartest money in the world, and I mean the people who actually move markets, not the talking heads on television, why they're positioning themselves in silver right now like their lives depend on it. Because in about 14 months, they might. Here's what nobody's telling you. The global silver shortage isn't coming. It's already here. We're mining less silver today than we did in 2015. Let me say that again because it's crucial. Global silver production peaked in 2015 at around 893 million ounces. Last year, 2025, we produced 821 million ounces. We're going backwards. Meanwhile, industrial demand for silver has increased by 47% since 2020. Those two lines on a graph, production going down, demand screaming upward, they're about to cross in a way that's going to shock the financial world. Now, I know what you're thinking. Jeff, you built a company worth almost $2 trillion by obsessing over customers and the cloud and logistics. What do you know about precious metals? Fair question. Let me tell you a story. In 2008, right after the financial crisis, I had dinner with a mining executive in Seattle. This wasn't some random meeting. I was researching supply chain vulnerabilities for Amazon. We were scaling fast, and I needed to understand commodity cycles because they affect everything from packaging to electronics. This guy, I'll call him Richard because that's actually his name. Richard told me something I've never forgotten. He said, Jeff, the world runs on silver and nobody knows it. Every solar panel, every electric vehicle, every smartphone, every electrical switch, they all need silver. And we're running out. I thought he was exaggerating. You know how people in every industry think their commodity is the most important thing in the world? But I did what I always do. I went deep. I spent 6 months having my team analyze silver supply and demand. And Richard was right. He was actually understating the problem. Fast forward to 2025, and that problem has become a crisis. But here's the thing, and this is where it gets interesting. The crisis isn't just about supply and demand anymore. It's about technology. It's about the future I've been building toward for 30 years. And it's about a convergence that's happening right now that maybe 12 people in the world fully understand. Let me paint you a picture of what's actually happening. In 2024, the world installed more solar panels than ever before in human history. Over 400 gigawatts of new solar capacity. Each gigawatt requires approximately 40,000 ounces of silver. You do the math, that's 16 million ounces of silver just from last year's solar installations. And that number is accelerating. The International Energy Agency projects will double solar installations by 2027. Double. Where do you think that silver is coming from? And solar is just one piece. Electric vehicles, and I'm not just talking about Tesla, although they're part of this story, electric vehicles use between 25 to 50 grams of silver per car. Conventional cars use 15 to 28 grams. Doesn't sound like much until you realize that by 2030, Analysts Project will be producing 40 million electric vehicles per year. That's another 50 to 60 million ounces of annual silver demand that didn't exist 5 years ago. But wait, there's more. And this is where my world intersects with this in ways people aren't seeing. Artificial intelligence, data centers, the cloud infrastructure that Amazon Web Services runs, that Microsoft runs, that Google runs, these facilities are expanding at a rate that would have seemed insane 10 years ago. We're building data centers in Ohio, in Virginia, in Oregon, facilities that consume more power than small cities. And every single one of them, every server, every circuit board, every connection point uses silver. The electrical conductivity properties of silver are unmatched. Copper is cheaper, yes, but silver is 60% more conductive. When you're running facilities where milliseconds matter and power efficiency directly impacts your profit margins, you use silver. Now here's what keeps me up at night, in a good way. The same way that figuring out how to get a package to your door in one day kept me up in 2005. We're at an inflection point. The artificial intelligence boom that everyone's talking about, the one that's making NVIDIA worth $3 trillion, that boom requires physical infrastructure. It's not just software. It's not just algorithms. It's warehouses full of chips and servers and cooling systems and power distribution, and all of that infrastructure needs silver. Jensen Huang is my friend. We've talked about this. He knows what's coming. The semiconductor industry is projecting they'll need 250 million ounces of silver annually by 2028. That's almost a third of current global production. Just for chips. You're starting to see the problem, right? But let me make it worse, or better, depending on whether you're positioned correctly. Industrial demand is only half the equation. Investment demand is about to explode. And when I say explode, I mean in a way that will make the 2011 silver spike look like a minor blip. In 2011, silver went from around $18 an ounce in January to nearly $50 by April. People who bought physical silver doubled their money in 4 months. My logistics team still talks about that period because we couldn't keep silver products in stock at Amazon. The U.S. Mint ran out of Silver Eagles. Completely out. They had to suspend sales. And that was when global silver demand was 60% of what it is today. What caused that spike? Fear. Quantitative easing. People worried about currency debasement. But the spike didn't last because industrial demand wasn't there to support it. It was purely speculative. When the fear subsided, silver crashed back down. By 2013, it was at $20. By 2015, $14. The people who bought at the top, the ones who panicked in at $48, they lost everything. But 2026 is different. Completely different. This time, the industrial demand is real, it's structural, and it's irreversible. You can't run the fourth industrial revolution without silver. You can't electrify transportation without silver. You can't power AI without silver. And you can't mine it fast enough to keep up. Let me give you some numbers that'll make your head spin. The Silver Institute, which tracks this stuff religiously, projects that industrial demand for silver will reach 650 million ounces in 2026. Meanwhile, mining production is expected to be around 830 million ounces at best, assuming no disruptions. That leaves a gap of, 180 million ounces that has to come from somewhere. Where? Above ground stockpiles, recycling, investor selling. But here's the kicker. Above ground stockpiles are at multi-decade lows. The COMEX warehouses, which is where the major silver trading happens in New York, they're sitting on around 270 million ounces. Sounds like a lot until you realize that in 2006, they had over 300 million ounces. We've been drawing down inventory for 20 years. The cupboard is almost bare. Recycling can't fill the gap either. Silver is different from gold. Gold gets recycled at an 85% rate because it's valuable enough that people bother. Silver gets used in such small quantities per application that recycling isn't economical for most uses. When silver is in your smartphone at 0.05 ounces, you're not extracting it when the phone dies. It goes to a landfill. Same with solar panels. They last 25 years, but when they're decommissioned, the silver is often lost. We're essentially throwing away industrial silver at a rate of hundreds of millions of ounces per year. That silver isn't coming back. So we've got demand going up, supply going down, and inventories depleting. In any other market, prices would already be skyrocketing. But silver's been stuck in this weird range between $22 and $32 for over 2 years now. Why? Manipulation. And before you think I'm putting on a tinfoil hat, let me explain what I mean. The silver market is tiny. The total value of all silver mined annually is maybe $28 billion at current prices. For context, Amazon's market cap is over 1.6 trillion. The entire annual silver market is less than 2% of Amazon's value. That's how small this market is. When a market is that small, it can be dominated by a few large players, and it is. The big banks, JP Morgan, HSBC, they trade silver futures in massive quantities. They can push prices around because the market is so thin. In 2020, JP Morgan paid a $920 million fine for spoofing the precious metals market. Spoofing means placing fake orders to manipulate prices. They admitted to doing it for years, and that was just what they got caught doing. The suppression of silver prices has been systematic and well documented. But here's the thing about manipulation. It only works until it doesn't. It only works until physical demand overwhelms paper gains. And we're about to hit that point. I'll tell you when I knew this was real. January 15th, 2026, I was in a meeting with our AWS infrastructure team. We were discussing our expansion plans for the next 5 years. One of our procurement specialists, brilliant woman named Sandra, she drops a bombshell. She says, "Jeff, we have a problem with silver. Our suppliers are telling us that lead times for silver-based components have doubled. Prices are creeping up despite futures being stable. We're seeing allocation, meaning suppliers are limiting how much we can buy." I stopped the meeting. I said, "Explain that to me." She showed me the data. Industrial buyers are hoarding. They're securing multi-year supply contracts at fixed prices. They're bypassing the futures market entirely. Why? Because they know what's coming. When Amazon can't get the components we need because of silver constraints, that's a red flag the size of Texas. We're Amazon. We have procurement power that can move global markets. If we're seeing constraints, everyone else is seeing worse. I immediately had a team do a deep dive. What they found shocked even me. The solar industry has already secured silver supply contracts through 2029 at prices well above current spot. Why would they do that? Because they know that by 2027, 2028, spot prices will be so high that those contracts will look like the deal of the century. The electric vehicle manufacturers, same thing. Tesla locked in silver supply through 2030. They're not stupid. They can see the same supply-demand charts I can. Now, let me connect some dots that most people are missing. There's a reason I'm telling you all this. And it's not just because I think silver prices are going up. It's because I've seen this movie before. I've lived through the moment when the world changes, and most people don't realize it until it's too late. In 1994, I saw that the internet was going to change everything. The data was obvious. Web usage was growing at 2,300% per year. Nobody was building infrastructure to sell things online. I left a great job on Wall Street, drove across the country, and started selling books out of a garage. People thought I was insane. Why would anyone buy books online when they could go to a bookstore? Fast forward 30 years, and Borders is gone. Barnes & Noble barely survived. And Amazon is one of the most valuable companies on earth. In 2003, I saw that cloud computing would transform technology. Everyone said it wouldn't work, that companies would never trust their data to someone else's computers. We built AWS anyway. It took 3 years before people realized we were right. Now AWS generates over $90 billion in annual revenue and powers half the internet. The pattern is always the same. You see an inevitable technological or economic shift. You see that the infrastructure doesn't exist to support it. You see that most people are in denial or simply not paying attention. And you act before the obvious becomes obvious to everyone. Silver in 2026 is that moment. Here's why I'm so confident about the timeline. The Shanghai International Energy Exchange is launching a silver futures contract denominated in yuan in March 2026. That's 2 months from now. China is the world's largest consumer of silver for industrial purposes. They use over 200 million ounces annually, and they're tired of having prices set in London and New York. When that yuan contract goes live, it will create a parallel pricing mechanism. Chinese industrial buyers will bid for physical silver in yuan. They'll bypass the Western futures markets. And because China is willing to pay up for actual metal, not paper contracts, that's going to establish a real price floor. But there's something else happening in March that almost nobody's talking about. The European Union's carbon border adjustment mechanism goes into full effect. What that means is that any silver mined with high carbon intensity, which is most silver from China and parts of South America, will face additional tariffs when entering the EU. The EU is a massive market for silver in electronics, solar, automotive. Those tariffs will force EU buyers to source from cleaner producers, primarily in Mexico, Peru, and Australia. But those producers are already near capacity. You can't just flip a switch and mine more silver. It takes 5 to 7 years to bring a new mine online. The EU is about to create a supply crunch in their own market, and prices there will spike first. I'm watching this unfold in real time, and it reminds me of when Amazon started building fulfillment centers in 2010 and 2011. Everyone said we were crazy to invest so much in infrastructure. We were spending billions on warehouses while our stock price stagnated. Wall Street hated it. But we could see that 1-day and 2-day delivery would become the standard. We could see that whoever controlled the logistics infrastructure would control e-commerce. So we built when it was cheap to build. By the time our competitors realized they needed fulfillment centers everywhere, real estate prices had doubled and they were 5 years behind. The smart money in silver is doing the same thing right now. They're accumulating while prices are suppressed. They're building positions while everyone else is distracted by artificial intelligence stocks and cryptocurrency. Let me tell you about someone you've never heard of. His name is David Chen. He runs a private investment fund that specializes in commodities. David started buying silver in 2023 when it was at $21 an ounce. His fund has accumulated over 50 million ounces of physical silver, not futures, not mining stocks, physical metal and allocated storage. I know this because David and I have mutual friends in the investment world, and his strategy got back to me. I was curious, so I had coffee with him in November. I asked him, David, why silver? Why now? He pulled out a chart. It showed silver's price relative to its industrial demand over the past 50 years. And there was this massive divergence starting in 2020. Demand was going vertical. Prices were flat. He said, Jeff, this is the most mispriced asset I've seen in my career. When this corrects, it won't be a 20 or 30% move. It'll be 300, 400%, maybe more. I didn't commit to anything in that meeting, but I thought about it. I went back and looked at the fundamentals myself, and David is right. This is mispriced. Dramatically mispriced. The question is, when does the market wake up? My best estimate, based on everything I'm seeing, is that the repricing begins in the second quarter of 2026. April, May, June. Why then? Because that's when the solar installation season kicks into high gear in the Northern Hemisphere. That's when the new Chinese yuan contracts will have been active long enough to establish price discovery. That's when the EU tariffs will start impacting supply chains. And that's when the industrial buyers who've been quietly hoarding will have exhausted their stockpiles and will be forced into the spot market to secure supply. When that happens, and it will happen, you're going to see something extraordinary. The paper silver market, the futures and options traded on the COMEX, they represent claims on about 1.2 billion ounces of silver, but the actual physical silver available for delivery is under 300 million ounces. It's a fractional reserve system, just like banking. It works fine until everyone shows up demanding their deposits at once. And industrial buyers are about to show up demanding physical metal. When they do, the price of paper silver and physical silver will diverge. You'll see premiums on physical bars and coins jump to 20, 30, maybe 50% above spot. And then spot itself will have to adjust because the paper price will become meaningless if you can't actually get metal at that price. I've seen this dynamic before in other markets. In 2021, during the semiconductor shortage, you could see a chip listed at $10 on paper, but if you actually wanted to buy one, you paid $40. The paper price was fiction. The real price was what someone with inventory would sell for. Silver is about to experience the same dislocation, but on a much larger scale. And here's the beautiful part, the cruel part if you're not positioned right. When prices start moving, the momentum will be self-reinforcing. As silver goes from $30 to $50, it will make headlines. Those headlines will drive investment demand. Investment demand will push prices to $70, $80. At $80, the total market cap of all silver is still under $2 trillion. That's smaller than Apple, smaller than Microsoft, smaller than Amazon. That's a rounding error in global financial markets. When billionaires and sovereign wealth funds decide they want exposure to the asset that's powering the energy transition and the AI revolution, they will flood into this market. And because the market is so small, their capital will move prices violently. We could see silver at $150 an ounce by the end of 2026, at $200 by mid-2027. And before you say that's crazy, let me remind you that silver hit $50 in 1980 when industrial demand was a fraction of what it is today. Adjusted for inflation, that's over $180 in today's money. And that was a purely speculative bubble. This time, the demand is real. Now, I can hear the skeptics. Jeff, if this is such a sure thing, why isn't everyone doing it? Why isn't it already priced in? Great question. Let me tell you why. First, most investors don't understand commodities. They understand stocks and bonds. They understand real estate. Commodities are harder. They don't pay dividends. They don't have earnings. You can't value them with a discounted cash flow model. Most financial advisors won't touch them because they don't fit the traditional portfolio framework. Second, silver specifically has a terrible reputation among sophisticated investors. It's seen as the poor man's gold. It's associated with conspiracy theorists and doomsday preppers. There's a stigma. Nobody wants to be the guy at the hedge fund who's pitching silver. You pitch AI, you pitch biotech, you pitch crypto. Silver is unsexy. Third, and this is important, the data is fragmented. If you want to analyze Apple, there's 10,000 analysts publishing research. Every number is public. Every product launch is covered. Silver, there's maybe 20 analysts globally who really understand this market. The data on industrial demand comes from obscure industry reports. Mine production numbers are published quarterly with a 3-month lag. By the time you see the official supply deficit, it's already happened. Fourth, the manipulation I mentioned earlier has conditioned people to think silver can't move. It's been range-bound for so long that traders just assume it will stay there. They've been burned before trying to call a bottom, so they ignore it. But the biggest reason, and I mean the real reason nobody's positioned for this, is that it requires you to think 5 years out. Wall Street thinks in quarters. If something isn't going to move in the next 6 months, they're not interested. Their compensation is based on this year's performance. Silver is a 2026, 2027, 2028 story. By the time it's obvious, by the time it's showing up in quarterly earnings reports as a major cost driver, it'll be too late to position. You'll be buying at $70 trying to ride it to 100 when you could have bought at $28 18 months earlier. This is where patient capital wins. This is where thinking like an owner, not a trader, pays off. Let me tell you what I'm doing personally. I'm not going to give you investment advice. I'm not a financial advisor, and I'm certainly not telling you to go bet your retirement on silver. But I'll tell you what I'm thinking about. I'm looking at physical silver as portfolio insurance. If the global financial system stays stable, if central banks figure out how to navigate this debt mess, if technology keeps advancing without major disruptions, then my stocks and my businesses will do fine. Amazon will thrive. Blue Origin will take people to space. My wealth will compound nicely. But if there's a disruption, if we see currency instability, if there's a major geopolitical event, if inflation comes roaring back, then physical silver becomes valuable in a different way. It's not just an industrial metal. It's a monetary metal. It's been money for 5,000 years. So I'm treating silver as asymmetric risk. If I'm wrong and silver goes nowhere, I lose maybe 10 or 20% if prices drift lower. But if I'm right and we see the supply crisis I'm describing, I make 300, 400, maybe 500%. That's not a gamble. That's a calculated risk with extraordinary upside and limited downside. The Bezos laugh. That's the kind of bet I like. The second thing I'm watching closely is silver mining stocks. Now, these are riskier than physical metal because you're taking on company-specific risk, management risk, operational risk. But the leverage is incredible. When silver prices move up 20%, mining stocks typically move up 60 to 80% because their profit margins expand dramatically. A silver miner that's profitable at $30 an ounce is wildly profitable at $50 an ounce. Their costs don't double just because the price doubled. I'm looking at companies like First Majestic, Hecla Mining, Pan American Silver. These aren't recommendations. I'm just naming companies I'm researching. The key is to find miners with low costs, strong balance sheets, and production growth. If silver goes to $70, $80, $100, these companies will generate cash like never before. Their stock prices will reflect that. But you have to be selective. Not all miners are created equal. Some have high costs, heavy debt, or are in risky jurisdictions. Do your homework. The third angle, and this is more speculative, is silver-backed exchange-traded products. The problem with the ETFs like SLV is that they don't always hold all the physical metal they claim. There's been controversy about whether the metal is actually allocated and audited properly. I'm more interested in vehicles that offer true allocated storage with third-party audits. Sprott Physical Silver Trust is one example. They publish bar lists showing every single bar they hold. That's transparency. But here's what I'm not doing. I'm not messing with silver futures or options unless you really know what you're doing. The leverage in those markets can wipe you out on a small move. I'm not buying numismatic coins at huge premiums. A silver eagle or maple leaf that trades for $5 or $6 over spot is fine. A rare coin that trades for 3 times melt value is a collectible, not an investment. And I'm not falling for schemes where someone sells you silver at inflated prices with promises of guaranteed buybacks. If it sounds too good to be true, it is. What I am doing is educating myself. I'm reading everything I can find on global silver supply chains. I'm talking to mining executives, to industrial buyers, to traders who've been in this market for 40 years. I'm building a mental model of how this market works so that when the move happens, I understand what I'm seeing. Knowledge is the real edge here, not some hot tip or insider information. It's understanding the fundamental forces at play. Now, let me tell you about the geopolitical dimension of this that almost nobody's discussing. Silver isn't just an economic story. It's becoming a national security issue. And I know something about that because Amazon Web Services works with the Department of Defense, with intelligence agencies, with critical infrastructure providers. We see things. In October 2025, there was a closed-door meeting in Washington. I wasn't there, but I know people who were. The topic was critical minerals and supply chain security. Silver was on the list. Why? Because if you can't get silver, you can't build missiles. You can't build radar systems. You can't build advanced electronics for F-35 fighters or Virginia-class submarines. The military uses silver extensively. And guess where most of the world's refined silver comes from? China processes about 20% of global silver production. Mexico and Peru mine a lot, but Chinese refineries handle a huge chunk of the processing. Now imagine a scenario, and this isn't far-fetched, where tensions with China escalate, maybe over Taiwan, maybe over trade, maybe over something else entirely. What happens to silver supply? China could restrict exports of refined silver, just like they've restricted rare earth elements in the past. In 2010, China cut off rare earth exports to Japan during a territorial dispute. Prices went ballistic. Companies scrambled. It was chaos. Silver could face the same weaponization. And if that happens, if silver becomes a geopolitical tool, prices won't just rise, they'll explode. Because suddenly it's not just about economics, it's about national security. It's about governments competing to secure supply at any price. The United States is way behind on this. We have almost no domestic silver refining capacity. We mine silver, sure, but we ship it overseas for processing and then import it back. That's insane from a strategic standpoint. The Department of Defense is aware of this vulnerability. There's been talk about subsidizing domestic refining capacity, about stockpiling strategic reserves, but talk is cheap. Actually building infrastructure takes years. In the meantime, we're dependent on foreign supply chains for a metal that's critical to our technological and military superiority. That dependency is going to drive policy changes. And those policy changes will impact prices. I'll give you an example of how this could play out. Let's say Congress passes a Critical Minerals Security Act in late 2026 or early 2027. They authorize $10 billion to build domestic refining capacity and establish a strategic silver reserve. To build that reserve, they need to buy, let's say 50 million ounces of silver. Where do they buy it? On the open market. That's 50 million ounces of demand hitting a market that's already tight. Prices spike. Then the private sector sees the government buying and thinks, if the government's buying, we should buy too. Investment funds pile in. Retail investors see the headlines and start buying silver, eagles, and bars. The price feeds on itself. This is how moves happen in small markets. One catalyst triggers a cascade. But here's the thing that really keeps me thinking about this late at night. It's not just the United States that's waking up to this issue. India is the world's largest importer of silver, over 200 million ounces per year. They use it for jewelry, for religious purposes, for industrial applications. The Indian government has been trying to reduce gold imports to protect their current account. So Indians are buying more silver instead. It's become the alternative precious metal. And Indian buyers are price insensitive. When they want it, they buy it. During wedding season, Diwali, major festivals, silver demand from India can swing global prices. If you layer Indian cultural demand on top of industrial demand, on top of investment demand, on top of government buying, you've got a perfect storm. China, meanwhile, is quietly accumulating. They don't announce it, they don't publish reserves data, but people in the market know Chinese state-owned enterprises have been buying silver mining companies in Latin America, in Africa, in Australia. Why would they do that if they didn't see strategic value? China thinks in decades they're positioning themselves to control supply chains for the technologies of the future. Electric vehicles, solar panels, AI infrastructure, all of it needs silver. If China controls the silver supply chain the way they control rare earths, they have leverage over the entire global economy. This isn't conspiracy theory. This is what every major power does. They secure access to critical resources. Let me tell you what happened in January that convinced me the timeline is accelerating. I got a call from a friend who runs a solar installation company. Big company, does commercial and utility scale projects. He was panicking. His suppliers told him they couldn't guarantee silver paste delivery for projects scheduled in the second half of 2026. Silver paste is what you use to make solar cells. Without it, you can't manufacture panels. He asked me, Jeff, what do I do? I told him to pre-buy as much as he could afford to stockpile. Lock in prices now. He thought I was crazy to tie up that much capital. But 2 weeks later, his competitors started doing the same thing. Now everyone's trying to secure supply. And when everyone's hoarding, the spot market dries up. That's when prices disconnect from fundamentals and just start reflecting panic. This is exactly what happened with toilet paper in March 2020. Remember that? COVID hits, people panic, they start hoarding toilet paper, stores run out, which makes more people panic and hoard. Prices don't even matter anymore. People are buying at any price just to have inventory. Silver is about to experience the industrial equivalent of the toilet paper panic, except it's not going to last 3 weeks. It's going to last 3 years, because you can ramp up toilet paper production in a month. You can't ramp up silver mining in less than 5 years. Now, I need to talk about timing, because that's what everyone always wants to know. When exactly is this going to happen? I can't give you a date. Nobody can. But I can tell you what I'm watching for. The first signal will be widening premiums on physical silver. Right now, you can buy a silver bar for maybe 2 or 3% over spot. When that premium goes to 10%, then 15%, then 20%, that tells you physical is getting scarce. Dealers can't get inventory. Mints are behind on production. That's your early warning. The second signal is backwardation in the futures market. Normally, futures prices are higher than spot because of storage and carrying costs. But when physical is tight, spot can trade higher than futures. That's called backwardation, and it's a massive red flag. It means people value having the metal now more than a promise to deliver it later. The third signal is when mining companies stop hedging. Miners often sell forward production to lock in prices, but if they believe prices are going much higher, they'll stop hedging. They'll want to sell at spot when the time comes. When you see major miners like Pan American or Endeavor announcing they're unwinding hedge books, that tells you they're expecting a big move. The fourth signal, and this is the big one, is when a major industrial buyer publicly announces they can't get silver at acceptable prices. If Samsung or LG or Panasonic goes public saying silver shortages are impacting production, that's when the mainstream media will finally pay attention. And once it's a headline story, the investment herd arrives. My best guess, and it's just a guess based on everything I'm seeing, is that we see the first tremors in March or April 2026. That's when the Shanghai Yuan contract launches. That's when EU tariffs bite. That's when solar season starts. You'll see premiums start to widen. You'll see some spot shortages in certain forms, like 1,000 ounce bars. The market will notice, but it won't panic yet. Then in June or July, we'll see the first major headlines. Silver hits $40, then $50. The financial press will write stories about the forgotten metal. Investors will start paying attention. By September, October, we're at $70, $80. Mining stocks have doubled or tripled. The momentum is undeniable. By the end of 2026, we're probably north of $100. And then the real move begins in 2027 as industrial buyers completely panic and governments start securing strategic reserves. Now, what could derail this thesis? Let me be honest about the risks, because I don't believe in one-sided arguments. The first risk is a major global recession. If the economy crashes, if we see a deflationary spiral like 2008, industrial demand for silver could crater. Solar installations get postponed. Electric vehicle sales collapse. Data center builds get shelved. Demand falls faster than supply, and prices drop. That's a real risk. The counter-argument is that in a recession, central banks print money like crazy, which drives people to hard assets like precious metals. So you might lose on industrial demand, but gain on monetary demand. It's hard to say which force would dominate. The second risk is a major new silver discovery. If someone finds a massive silver deposit that's economical to mine quickly, that could flood the market with new supply. But I've looked at the pipeline of mining projects, and there's nothing like that on the horizon. The biggest new mines coming online in the next 5 years will add maybe 40 or 50 million ounces of annual production combined. That doesn't move the needle when demand is growing by 100 million ounces per year. The third risk is technological substitution. Maybe someone invents a solar cell that doesn't need silver. Maybe someone figures out how to make semiconductors with copper instead. Innovation happens, but from everything I know about material science, silver's unique properties, its conductivity, its reflectivity, its antimicrobial characteristics, those aren't easy to replace. We've been trying to find substitutes for decades. We haven't succeeded. The fourth risk, and this is a big one, is government intervention. If silver prices go to $150, $200, governments might do something stupid. They might impose export controls, they might nationalize mines, they might mandate rationing. Political risk in commodities is real. You have to factor it in. The fifth risk is that I'm wrong about the timeline. Maybe the supply crunch I'm predicting doesn't materialize until 2028 or 2030. Maybe above ground stocks are larger than reported. Maybe recycling rates improve. Maybe industrial buyers find ways to use less silver per unit. If the thesis plays out but takes 5 more years, that's a lot of dead capital sitting in a non-yielding asset. You have to be patient, and patience is expensive. But even accounting for those risks, the risk reward here is extraordinary. Let's do the math. You buy silver today at, let's say, $30 an ounce. Your downside in a really bad scenario, recession, no shortage, everyone was wrong, is probably $20. So you risk 33%. Your upside, if the shortage thesis plays out even moderately, is $100 to $150. That's 230 to 400%. If it plays out aggressively, you're looking at $200+, which is 560+%. Those are venture capital returns on a tangible, liquid, global commodity. You don't get that risk-reward profile very often. Let me connect this back to something I learned building Amazon. In the early days, everyone told me e-commerce would never work. Too much friction. People want to touch products. Shipping costs would kill margins. Returns would be a nightmare. I heard every objection imaginable, but I looked at the data. Internet usage was growing at 2,300% per year. Online transactions were doubling every 9 months. The trend was undeniable. So I bet on the trend, not on the current state. I was willing to be misunderstood for years while we built the infrastructure. Silver is the same thing. Everyone's telling you it's a dead market. Nobody cares about silver. Industrial demand doesn't matter because supply always catches up. But the data says otherwise. The trend is undeniable. You just have to be willing to be early. Being early looks the same as being wrong for a while. I remember in 2003, when we were building AWS, we were spending hundreds of millions on data centers and infrastructure for a product that didn't have customers yet. Our CFO thought I'd lost my mind. The board was skeptical. Wall Street punished our stock. But I knew that cloud computing was inevitable. The economics made too much sense. Every company would eventually move to the cloud because it was cheaper, faster, and more flexible than running your own servers. I was right. But I was right 3 years before it became obvious. If I'd waited for it to be obvious, we wouldn't have been first. We wouldn't have built a $90 billion business. Silver in 2026 is like cloud computing in 2003. The people who understand it now, who position themselves before it's obvious, they're the ones who'll make generational wealth. Here's another parallel. In 2013, I bought the Washington Post. Everyone thought I was nuts. Print media is dying. Newspapers are dinosaurs. Why would a tech guy buy a newspaper? I bought it because I saw that the Post had an incredible brand, world-class journalists, and a mission that mattered. What they didn't have was technology and a business model for the digital age. I could provide that. We invested in technology. We focused on digital subscriptions. We built a sustainable model. 7 years later, the Post is thriving. It's profitable. It's growing. Was it obvious in 2013? No. Did I have to endure people calling it a vanity project? Absolutely. But I saw the value that others missed. Silver is the same. People see a commodity that's been boring for a decade. I see the linchpin of the entire fourth industrial revolution. Let me share something personal that I've never talked about publicly. In 2009, right after the financial crisis, I almost bought a silver mining company. I'd been researching the sector, and I found a small miner in Mexico that was undervalued. Great deposits, low cost, good management. I got all the way to due diligence. But ultimately, I passed. Why? Because Amazon was at an inflection point. We were launching new categories, expanding internationally, building AWS. I needed all my capital and focus there. Looking back, that mining company increased 20-fold over the next decade. I left 20 times my money on the table. Did I regret it? Not really, because Amazon increased 40-fold in that same period. But it taught me something. When you see an asymmetric opportunity in an unloved, misunderstood asset, and you have capital available, you take it. Because those opportunities don't come along often. Now I'm in a different position. Amazon runs itself in many ways. We have incredible leaders running every division. Blue Origin is progressing toward our mission of lowering the cost of space access. My philanthropic work through the Bezos Earth Fund is addressing climate change. I have the bandwidth to think about other opportunities. And silver is screaming at me as an opportunity. It's not my main focus, but it's something I'm paying very close attention to. Because when the move happens, it's going to be violent and fast. And I don't want to be on the sidelines wishing I'd acted. Let me tell you about a conversation I had with Charlie Munger before he passed. Charlie was Warren's partner, one of the wisest investors who ever lived. We were at a dinner, must have been 2022, and I asked him about commodities. Charlie said something I'll never forget. He said, "Jeff, commodities are a lousy business most of the time. There's no moat. It's all about price. You can't differentiate a ton of copper from anyone else's ton of copper. But every 20 years or so, you get a super cycle. Supply and demand get completely out of whack because of some structural shift. And in those moments, the dumbest person who owns the commodity makes more money than the smartest person who doesn't. The trick is recognizing when you're at the beginning of one of those cycles and having the guts to act." Charlie was talking about the China commodity super cycle of the 2000s. From 2000 to 2008, commodity prices went insane. Oil went from $20 to $147. Copper tripled. Iron ore went from $30 a ton to $200. Why? Because China was industrializing at a pace the world had never seen. They were building cities, infrastructure, factories. They needed raw materials, and supply couldn't keep up. The people who owned commodity producers or the physical commodities made fortunes. I think we're at the beginning of a similar cycle with silver, not because of China industrializing, but because of the world electrifying and digitizing, and silver is the enabling commodity for that transition. Here's what I want you to understand. This isn't about getting rich quick. This isn't about gambling on some speculative frenzy. This is about recognizing a fundamental supply-demand imbalance that will take years to resolve and positioning yourself accordingly. If you approach it that way, with patience and conviction, you'll do well. If you approach it as a trade, trying to catch every swing, you'll probably lose. The way I think about it is this. Silver at $30 is mispriced based on its industrial importance and scarcity. At some point in the next 12 to 36 months, the market will correct that mispricing. When it does, silver will revalue to reflect its true worth. That revaluation could happen over 3 months or 3 years. I don't know, but I'm confident it will happen. And when it does, the people who owned silver when it was $30 will see their wealth increase dramatically. Not because they were smart traders, not because they timed the market perfectly, but because they understood the fundamentals and had the patience to wait for the market to recognize what they already knew. That's value investing in commodities. That's what I'm doing. Now, let me address something that I'm sure some of you are thinking. Jeff, you're a billionaire. You can afford to take risks that normal people can't. If you're wrong about silver, it doesn't matter to you. Why should we listen to you? Fair point. But here's the thing. I didn't become a billionaire by making stupid bets. I became a billionaire by understanding risk reward, by focusing on long-term value creation, and by being willing to endure short-term misunderstanding for long-term success. The principles I'm applying to silver are the same principles I applied to building Amazon. Focus on the customer, which in investing means focus on fundamentals. Think long-term, which means ignore short-term price noise. Be willing to be misunderstood, which means don't need validation from the crowd. Build a margin of safety, which means don't bet more than you can afford to lose. Those principles work whether you have $1 billion or $10,000. The amounts are different, but the approach is the same. If you have $10,000 and you put $2,000 into physical silver, you're applying the same asymmetric risk framework I am. You're risking $2,000 to potentially make $8,000 or $10,000. That's a meaningful return. Could it go to zero? No. Silver's not going to zero. It's been valuable for 5,000 years. Could it go down? Sure. Could it go sideways for a few years? Absolutely. But if the thesis is right, your 2,000 becomes 10 or 15,000. And that could be life-changing money for someone trying to build wealth. One more thing I want to emphasize. This is not financial advice. I'm not telling you to go buy silver. I'm not a registered investment advisor. I'm sharing my analysis and my thinking. You need to do your own research. You need to understand your own risk tolerance. You need to make your own decisions. What works for me might not work for you. But I will say this. In my entire career, I've seen maybe 10 or 12 opportunities that were truly exceptional. Moments where the risk reward was so skewed in your favor that not acting was almost irrational. Starting Amazon in 1994 was one of those moments. Building AWS in 2003 was another. Buying the Washington Post in 2013 was another. I think silver in 2026 is one of those moments. It might be the last one I see at this scale in my lifetime. So what do you do with that information? That's up to you. But I'll tell you what I'd do if I were starting over today with limited capital. I'd take 5 to 10% of my investable assets and put them in physical silver. Not mining stocks, not ETFs, physical metal that I control. I'd buy it from a reputable dealer, store it securely, and forget about it for 3 years. I wouldn't check the price every day. I wouldn't try to trade it. I'd just hold it as insurance against the supply crisis I see coming, and as a leveraged bet on the technology transition that's already underway. Then I'd focus the other 90 to 95% of my capital on building skills, investing in businesses I understand, and creating value in the world, because that's still the best way to build wealth. Active value creation beats passive speculation every time. But having 5 or 10% in silver, that's not speculation. That's prudent diversification based on a well-researched thesis. It's recognizing that we live in an uncertain world where the consensus is often wrong and where patient capital gets rewarded for seeing what others miss. It's the same mindset that drove me to start an online bookstore when everyone said it would fail. The same mindset that drove me to invest billions in cloud computing when it wasn't even a recognized category. The same mindset that's driven every major decision I've made in my career. See what others don't see. Act before it's obvious. Be patient while the world catches up. You know, people always ask me about regrets. Do I regret not buying Google when I had the chance? Do I regret not investing in Facebook early? Sure, I missed opportunities. Everyone does. But the regrets that haunt me aren't the things I tried and failed at. They're the things I saw clearly, understood deeply, and didn't act on because I was too cautious or too busy or too worried about what people would think. I don't want silver to be one of those regrets. And I don't want it to be one of yours either. because I'm telling you as clearly as I can that this opportunity is real. The supply-demand fundamentals are undeniable. The timeline is compressed, and the potential returns are extraordinary. In 5 years, we'll look back at silver trading at $30 in early 2026, and it'll seem insane. It'll be like looking at Amazon stock at $5 in 2001, or Bitcoin at $1,000 in 2017. People will say, how did we miss that? It was so obvious. But it's only obvious in hindsight. Right now, it's contrarian. It's weird. It's the thing nobody's talking about at cocktail parties. And that's exactly when you want to act. When the asset is unloved, when the thesis is clear, but the crowd hasn't arrived yet. That's your edge. That's your moment. I'm going to leave you with one final thought. It's day one. That's my philosophy at Amazon. It's always day one. The moment you think you've figured everything out, the moment you stop being curious and hungry and willing to challenge assumptions, that's when you start dying. Companies die because they stop innovating. Investors lose money because they stop thinking. They follow the herd. They extrapolate the recent past into the future. They miss the inflection points. I've built my entire career on staying in day one mentality, on always asking what's changing, what's being missed, where are the opportunities that others don't see. Silver in 2026 is a day one opportunity. The world is changing. We're electrifying everything. We're building artificial intelligence infrastructure at scale. We're transitioning to renewable energy. And all of that requires silver. But the market hasn't priced it in yet. The crowd is still focused on the sexy stuff, on AI stocks and crypto and whatever Elon tweeted today. They're not looking at the boring gray metal that makes it all possible. That's your opportunity. That's where fortunes get made. Not by chasing what everyone's already chasing, but by seeing what's inevitable before it becomes obvious. So stay curious, do your research, think for yourself, and when you see an opportunity that makes sense, that aligns with fundamental trends that you understand, have the courage to act. Don't wait for permission. Don't wait for validation. Don't wait until it's safe and comfortable and everyone agrees with you, because by then, the opportunity is gone. Act when it's uncomfortable. Act when you're early. Act when you might be wrong, but the risk-reward is so compelling that being right just once is worth being wrong 9 times. That's how I've approached business. That's how I've approached investing. And that's how I'm approaching silver right now. The metals are real. The shortage is coming. The price will adjust. The only question is whether you'll be positioned when it does. I can't make that decision for you, but I can tell you that I'm making it for myself. I'm paying attention. I'm learning. And when the moment is right, I'll act decisively, because that's what day one looks like. That's what building the future looks like. And silver, whether people realize it yet or not, is a critical piece of that future. Thank you for listening to an old entrepreneur talk about commodities. Now, if you'll excuse me, I have a rocket to launch and a world to explore, but I'll be watching silver prices while I'm doing it, and I think you should be too.